Have you ever noticed how the safest financial advice is the stuff everyone agrees on? Save your money in a savings account, buy bonds, keep everything secure, don't take risks. And yet, here's what nobody talks about. The people following this safe advice to the letter are often the ones who can never seem to get ahead financially. Meanwhile, the people building real wealth, they're doing something completely different. Here at Simple Money, I've spent years analyzing why some people's money grows while others watch their savings slowly lose value. And what I've discovered might make you rethink everything you thought you knew about safe investing. Because here's the uncomfortable truth. Some of the most popular safe investments aren't just failing to grow your wealth, they're actively making you poorer. And the worst part, you probably don't even realize it's happening. Today, I'm going to show you the 5 so-called safe investments that are quietly draining your financial future. And more importantly, I'll explain why our brains trick us into thinking these are good ideas in the first place. Let's start with something that sounds crazy at first. What if I told you that keeping your money safe is one of the riskiest things you can do? I know. That sounds backwards, but stick with me here. See, we've been taught that risk means volatility, up and down movements, the possibility of losing money, and safety means stability, keeping what you have, no surprises. But here's what's really happening. While you're protecting yourself from the risk of loss, you're exposing yourself to a different risk entirely, the risk of erosion. Think about it like this. Imagine you're trying to stay healthy, so you decide to never leave your house. No cars, no stairs, no potential for injury. You're completely safe from accidents, but while you're inside feeling secure, your muscles are atrophying, your cardiovascular health is declining, your bone density is decreasing. You're not in danger from anything external, but you're getting weaker every single day. That's exactly what happens with overly safe investments. They protect you from the scary stuff you can see, but they expose you to the invisible threat you're ignoring. And that invisible threat, it has a name. Inflation. But inflation isn't the only problem here. There's something even more insidious happening. Something that affects your psychology, your decision-making, and ultimately your entire financial trajectory. Let me show you what I mean. The first trap is what I call the nominal illusion. Here's how it works. You put $10,000 into a savings account paying 1% interest. A year later, you have $10,100. Your brain sees this and thinks, great, I made money. I have more dollars than I started with. But here's the thing. If inflation during that year was 3%, you didn't make money. You lost purchasing power. That $10,100 can now buy less than your original $10,000 could buy a year ago. You went backwards, but it doesn't feel like you went backwards because the number got bigger. This is the nominal illusion. Your brain focuses on the nominal amount, the actual number of dollars, instead of the real value, which is what those dollars can actually buy. It's like celebrating that you got a 5% raise while ignoring that prices went up 7%. You're making more money in absolute terms, but you can afford less than you could before. You got poorer, but the bigger paycheck tricks you into feeling richer. Here's why this matters so much. When you fall for the nominal illusion, you make terrible long-term decisions without realizing it. You keep your emergency fund in a savings account for years, watching the balance slowly grow, feeling financially responsible. Meanwhile, the real value of that fund is shrinking. Your safety net is getting smaller, but you can't see it happening. And here's the psychology behind why we fall for this. Our brains evolved to track concrete things. 3 apples, 5 deer, 10 people in the tribe. We did not evolve to understand abstract concepts like purchasing power or inflation-adjusted returns, so we default to the simple thing we can see, the number in our account getting bigger. The financial industry knows this, by the way. That's why they advertise nominal returns and rarely talk about inflation-adjusted returns. They know you'll feel better seeing a positive number, even if it represents a real loss. The second trap is what I call the guarantee tax. This one's particularly sneaky because it exploits something good about human nature, our desire for certainty. Here's how it works. You see two investment options. Option A guarantees you 2% returns. Option B historically averages 7% returns but fluctuates year to year. Your brain immediately gravitates toward option A. Why? Because the word guarantee feels so good, it's certain, it's safe, you know exactly what you're getting. But here's what nobody tells you. That guarantee has a cost, and that cost is enormous. Let's do the math. $10,000 at 2% guaranteed for 30 years becomes $18,100. $10,000 at 7% average for 30 years becomes $76,100. That's a difference of $58,000. That's the guarantee tax. That's what you paid for the feeling of certainty. Now, you might be thinking, but what if the 7% option has a bad year? Sure, it might. Some years it'll be up 12%, some years it'll be down 3%. That's volatility. But here's the thing. Volatility and risk are not the same thing. Volatility is temporary fluctuation. Risk is permanent loss of capital. When you're investing for 30 years, short-term volatility doesn't matter. What matters is the long-term trajectory. And historically, diversified investments have always recovered from downturns given enough time. So why do we pay the guarantee tax? Because our brains are wired for immediate threats, not long-term outcomes. Imagine you're a hunter-gatherer. You hear a rustling in the bushes. Option A, assume it's dangerous and run. Option B, assume it's probably nothing and investigate. Option A keeps you alive. The one time you're wrong and it's actually a predator, option B gets you killed. So we evolved to be hypersensitive to immediate threats and to value certainty over probability. This served us well for survival, but it's terrible for investing. Because in investing, the biggest threat isn't the scary volatility you can see, it's the slow erosion you're ignoring. The guarantee isn't protecting you, it's locking you into guaranteed poverty. The third trap is the liquidity trap. Now, this one sounds responsible on the surface. You want to keep your money liquid, meaning accessible, in case you need it. Makes sense, right? But here's where it gets interesting. When you prioritize liquidity above all else, you pay a massive opportunity cost. Think about it. Money in a checking account is maximally liquid. You can access it instantly, but it earns basically nothing. Money in a certificate of deposit is less liquid. You can't touch it for a year, but it earns more. Money in a retirement account is even less liquid. You can't access it without penalties until you're older, but it has the potential to earn much more. See the pattern? Liquidity and returns are inversely related. The more liquidity you demand, the less growth you get. But here's the psychological trap. We overestimate how much liquidity we actually need. Way overestimate. You tell yourself you need $20,000 sitting in checking account just in case. Just in case of what exactly? An emergency, you say, but you already have an emergency fund. And you have credit cards, and you could sell investments if you truly needed to. What's really happening is you're keeping money liquid not because you rationally need it, but because having it accessible makes you feel secure. It's a security blanket, and that security blanket is costing you tens of thousands of dollars in lost growth. Here's a crazy statistic. The average American keeps way more in their checking account than they need for monthly expenses. That excess cash earns basically 0% while inflation eats away at it. Why? Because taking that money and investing it feels like you're making it unavailable. It feels like you're losing control. Even though you could sell those investments in a few days if needed, your brain treats it as gone. This is called mental accounting. You put money into different mental buckets, and once it's in the invested bucket, you treat it as unavailable, even though it's not. The people building wealth understand something crucial. True liquidity isn't about keeping cash in a checking account. True liquidity is having diverse assets that can be converted to cash when needed. They keep 3 to 6 months of expenses in high-yield savings for actual emergencies. Everything else gets put to work because they understand that excess liquidity isn't safety, it's stagnation. The fourth trap is the preservation obsession. This is where things get really uncomfortable because this trap affects the people who are trying to do everything right. Here's the scenario. You've saved up $50,000. Maybe it's your life savings, maybe it's an inheritance, maybe you've been saving for 10 years and now you're terrified of losing it. So you put it somewhere safe. A money market fund, treasury bonds, maybe a high-yield savings account if you're feeling adventurous. Your logic is simple. You worked hard for this money, you can't afford to lose it. So you need to preserve it above all else. But here's what's really happening. In your effort to preserve the money, you're guaranteeing that it shrinks in real term. You're so focused on not losing it that you've made it impossible to grow it. This is the preservation obsession, the belief that the most important thing is to not lose what you have. And it sounds so reasonable, so responsible, so mature, but it's based on a fundamental misunderstanding of how wealth actually works. See, the goal isn't to preserve money. The goal is to preserve and grow purchasing power. Those are not the same thing. If you have $50,000 today and $50,000 in 10 years, you haven't preserved your wealth. You've lost roughly 30 to 40% of your purchasing power, assuming historical inflation rates. The preservation obsession comes from a cognitive bias called loss aversion. Psychologists have found that humans feel the pain of loss about twice as strongly as the pleasure of gain. Losing $100 feels worse than gaining $100 feels good, so we become paralyzed. We'd rather guarantee a small loss through inflation than risk a potential larger loss through investing. Here's the thing though, the preservation obsession isn't really about the money, it's about identity and self-worth. That $50,000 isn't just money, it represents years of sacrifice, discipline, doing without. It's proof that you're responsible, that you're not like those irresponsible people who spend everything. Losing it wouldn't just mean having less money, it would mean you failed, that all that sacrifice was for nothing, that you're not as smart or careful as you thought, so you cling to it, you preserve it, and in doing so, you rob yourself of the compound growth that could have turned 50,000 into 200,000 over a couple of decades. The cruel irony? The people who are least able to afford losses are the most likely to fall into the preservation obsession, because when you don't have much, every dollar feels precious. So you protect it so carefully that it never has a chance to multiply. The fifth and final trap is what I call the simplicity seduction. This one's subtle, and it affects even people who know better. Here's how it manifests. You know you should invest, you know you should diversify, but the options are overwhelming. Stocks, bonds, ETFs, index funds, real estate commodities, target date funds, growth versus value, international versus domestic. It's paralyzing. So you gravitate toward the simplest option available, a savings account, a single bond fund, whatever requires the least decision-making and maintenance. You tell yourself, at least I'm doing something. Simple is better than perfect. I'll optimize later when I understand more. But later never comes, and that simple solution is quietly costing you a fortune. Here's why this happens. We live in an age of infinite options, and psychologists have discovered something called the paradox of choice. The more options we have, the less satisfied we are with our decisions, and the more likely we are to avoid deciding altogether. So we cope by choosing simplicity. One savings account, one fund, one strategy. It feels manageable, understandable, safe. But here's what nobody tells you. The simplest financial products are almost always the worst deals. Why? Because simplicity is valuable to you, and companies charge for that value. That easy to understand savings account? It's easy because the bank is doing nothing except holding your money, and in exchange for that simplicity, you're accepting terrible returns. That simple whole life insurance policy that combines insurance and investment, it's simple because it's packaging multiple products together while skimming huge fees off the top. Complexity in finance isn't always bad. Sometimes complexity exists because the world is actually complex. A diversified portfolio of index funds is more complex than a savings account, sure, but that complexity is capturing real economic growth across multiple sectors and geographies. The simplicity seduction is particularly dangerous because it feels like wisdom. Keep it simple, stupid. Don't invest in things you don't understand. These sound like smart principles, but they're being applied wrong. The goal isn't to choose simple products. The goal is to build understanding so you can choose effective products. Here's the truth. Building wealth requires a baseline level of financial literacy. Not expert level, not professional level, but baseline. And that takes effort. The people who build wealth don't choose the simplest option. They choose the most effective option and make it simple for themselves through automation and systems. They spend a weekend learning about index funds, then they set up automatic contributions. The product isn't simple, but their interaction with it is. The simplicity seduction makes you think you're being smart by avoiding complexity. But really, you're being lazy, and that laziness has a price tag. Now, here's what makes all of these traps so insidious. They don't feel like traps. The nominal illusion doesn't feel like an illusion, it feels like math. You had $10,000, now you have $10,100. That's more. End of story. The guarantee tax doesn't feel like a tax. It feels like prudence, like being responsible instead of reckless. The liquidity trap doesn't feel like a trap. It feels like preparedness, like being smart enough to expect the unexpected. The preservation obsession doesn't feel like an obsession. It feels like common sense. Don't lose what you have. And the simplicity seduction doesn't feel like a seduction. It feels like wisdom. Keep things simple. Focus on what you understand. Every single one of these traps is disguised as good financial behavior. That's what makes them so effective. And here's what nobody wants to admit. The financial services industry benefits from you falling into these traps. Banks love that you fall for the nominal illusion. They can advertise 1% interest rates and you feel like you're making money while they lend that money out at 7% and pocket the difference. Bond fund companies love that you'll pay the guarantee tax. They can offer you guaranteed mediocre returns while charging management fees on top. Financial advisors love the preservation obsession. They can park your money in conservative allocations and you'll feel grateful for the safety while they collect their percentage every year. And everyone loves the simplicity seduction because simple products are cheaper to administer while commanding premium prices from consumers who value ease of use. I'm not saying there's some massive conspiracy here. I'm saying that the incentives are misaligned. What's easy and profitable for financial companies to sell is often what's worst for you to buy. And your own psychology is working against you every step of the way. Your brain is trying to keep you safe using rules that worked for survival on the savannah, but fail spectacularly in modern financial markets. This isn't a character flaw, this is being human. But understanding that you're wired this way is the first step to overcoming it. Let me tell you about Jennifer. She's 35 years old, she makes $65,000 a year, and she's been financially responsible her entire adult life. Jennifer started saving when she got her first real job at 22. She opened a savings account at her local bank and set up automatic transfers of $300 every month. 13 years later, she has about $55,000 saved up. She's incredibly proud of this, and she should be. Most people her age have way less saved. But here's what Jennifer doesn't realize. Over those 13 years, inflation averaged around 2.5% annually. Her savings account paid about 0.5% for most of that time. So while Jennifer was diligently saving, her money was losing about 2% of its purchasing power every year. Compounded over 13 years, that's a huge difference. If Jennifer had simply matched inflation, her savings would have the same purchasing power as what she put in. But she didn't match inflation. She fell short by 2% every single year. That $55,000 she has, in terms of the purchasing power of her first dollar saved, it's worth the equivalent of about $42,000. She saved $55,000 nominal dollars but only has $42,000 worth of purchasing power. She lost $13,000 to the nominal illusion that... But Jennifer doesn't see it that way. She sees $55,000 in her account and feels successful. When her friends struggle or when she reads articles about how most Americans can't cover a $500 emergency, she feels secure. She's fallen into every trap we talked about. The nominal illusion makes her think she's getting ahead. The guarantee tax made her choose the safety of a savings account over investments. The liquidity trap keeps all her money in immediately accessible cash. The preservation obsession prevents her from taking any risk with her hard-earned savings. And the simplicity seduction keeps her from learning about better options. Jennifer is doing everything society tells her to do, and she's slowly, invisibly, predictably getting poorer. Now, let me tell you about Marcus, same age as Jennifer, same income, started saving at the same time. But Marcus did something different. In his first year of saving, he put $3,600 into a savings account as an emergency fund. Then he stopped. For the next 12 years, instead of adding to his savings account, Marcus put that same $300 per month into a low-cost index fund tracking the total stock market. Over those 12 years, the market had ups and downs. Some years were great, some years were scary. There was even a pandemic-induced crash in there. But over the full 12 years, Marcus's investments averaged about 8% annual returns after inflation, not 8% nominal, 8% real inflation-adjusted returns. Today, Marcus has that $3,600 emergency fund in savings, which has lost some value to inflation, but he also has about $73,000 in his investment account. Same income, same monthly savings amount, but Marcus has $18,000 more than Jennifer. That's almost a third more wealth. Here's what's crazy. Marcus didn't work harder than Jennifer. He didn't make more money than Jennifer. He didn't inherit anything Jennifer didn't have. The only difference was understanding. Marcus understood that safety isn't about avoiding volatility. It's about giving your money the opportunity to grow faster than inflation. He understood that volatility is the price you pay for long-term returns. And over 12 years, he had plenty of time to ride out the volatility. He understood that real liquidity comes from having diverse assets, not from keeping everything in cash. He understood that preservation means preserving purchasing power, not preserving nominal dollar amounts. And he understood that a little bit of complexity up front, learning about index funds and setting up automatic investments, creates long-term simplicity and vastly better results. Marcus isn't special. He's not a finance genius. He just avoided the 5 traps that Jennifer walked right into. And the gap between them will only grow over time. Compound growth is exponential. Every year, Marcus stays invested, the gap widens. In another 13 years, Marcus could have $200,000 while Jennifer has $90,000. Same discipline, same sacrifice, completely different outcomes, all because of understanding. Here's what most people don't realize. The biggest risk in investing isn't losing money in a market crash. The biggest risk is playing it so safe that you guarantee you'll never build wealth. See, market crashes are temporary. History shows us that markets always recover eventually. Always. It might take 2 years, it might take 5 years. But if you're investing for 20 or 30 years, a temporary crash doesn't matter. But inflation is permanent. Every year prices go up, your cash loses value. And unlike market crashes, that lost purchasing power never comes back. You can recover from a market crash by waiting. You cannot recover from inflation by waiting. Waiting makes the inflation damage worse. So when you choose the safe option to protect yourself from market risk, you're actually choosing the risky option. You're just choosing a different kind of risk, a risk that's invisible, guaranteed, and permanent. This is the fundamental reframe. Safe and risky aren't about volatility. They're about long-term outcomes. A volatile investment that grows your wealth over time is actually safer than a stable investment that erodes your wealth over time. Because the whole point of investing is to end up with more purchasing power than you started with. Think about it this way. Would you rather take a cross-country road trip on a smooth highway that's slowly sinking into the ocean, or a bumpy mountain road that takes you to higher elevation? The smooth highway feels safer moment to moment, but you're going to end up underwater. The bumpy road feels riskier moment to moment, but you're going to end up on solid ground at a higher altitude. That's the difference between safe investments that make you poor and volatile investments that build wealth. The question isn't whether volatility makes you uncomfortable. Of course it does. The question is whether you're willing to tolerate short-term discomfort for long-term security. And here's the thing, you don't even have to look at it. Marcus checks his investment account maybe twice a year. The volatility is happening, but he's not experiencing it emotionally because he's not watching every fluctuation. Jennifer checks her savings account all the time. She likes seeing the balance, but that smooth, predictable growth is an illusion. Her purchasing power is fluctuating just as much as Marcus's, she just can't see it. She's experiencing the comfort of stability while suffering the consequences of erosion. He's experiencing the discomfort of volatility while reaping the rewards of growth. It's not actually about being brave or having a high-risk tolerance. It's about understanding the real risk and choosing the path that leads to actual long-term security rather than the path that merely feels safe today. The nominal illusion, the guarantee tax, the liquidity trap, the preservation obsession, the simplicity seduction. These aren't character flaws. They're not signs that you're bad with money. They're predictable patterns that exist because your brain is wired for a different world than the one we live in. Your ancestors needed to avoid immediate threats, grab immediate opportunities, and think in concrete terms. That kept them alive, but it makes you financially fragile. The difference between people who build wealth and people who stay stuck isn't intelligence. It's not willpower. It's not even income. It's understanding these patterns, seeing the invisible forces that are working against you, and making different choices. You don't need to become a finance expert. You don't need to day trade or pick stocks or time the market. You just need to understand enough to avoid these 5 traps. Keep an emergency fund in high-yield savings. Put your long-term money in diversified, low-cost index funds. Automate your investments so you're not making emotional decisions. And then stop watching the day-to-day fluctuations. That's it. That's the whole game for most people. It's not complicated, but it does require you to think differently about what safe actually means. The question isn't whether you can build wealth. The question is whether you're willing to let go of the comforting illusions that make you feel safe today while making you poorer tomorrow. Because here's the thing, 10 years from now, you're going to wish you started today. The best time to escape these traps was 13 years ago. The second best time is right now. What are you going to choose?